everyone, welcome to EduTap and welcome to today's Finance 360-degree session. So in today's session, we are going to discuss three very important articles regarding the NBFCs. So there is the major change that has happened. There is the major update that the RBI has done regarding the scale-based regulatory framework. So we'll discuss that what is the scale-based regulatory framework as well as what are the changes that have been done. So today we are going to discuss these three news articles or the articles of the RBI. So these are the three RBI notifications that we have to discuss in today's session. Okay, and all these are very important as the scale-based regulatory framework of the RBI. It is very important for the NBFCs for your RBI Grade B 2026 Phase 2 examination. This is very important as well as for the students that are preparing for the 2027. These articles are going to be very important because today you will get to know that what is the scale-based regulatory framework of the RBI and what are the major updates that the RBI has done. Okay, so give me a thumbs up if I'm clearly audible and the screen is visible. Okay, so I think everything seems fine. So let's get started. So these are the three articles that we are going to discuss in today's session. These are the three RBI notifications that we have to discuss. The first one is the Reserve Bank of India NBFC's registration exemptions and framework for scale-based regulation, Second Amendment directions. Then we have to discuss about the concentration risk management and the governance amendment directions. So let's get started with the first one, that is the RBI NBFCs registration exemptions and scale based regulation. See the NBFCs, first of all, see the NBFCs, they are divided into four layers. Okay, the NBFCs, they are divided into four layers, that is your base layer, middle layer, upper layer and top layer. The higher you go, the riskier the NBFCs are considered, the more rules and regulations the NBFCs have to follow. The more rules and regulations the NBFCs have to follow. Okay, so the NBFCs are divided into the four layers on the basis of the size, activity, and the risk that is perceived by the Reserve Bank of India. Okay, so on the basis of the size, activity, and the risk, the NBFCs are divided into the base layer, middle layer, upper layer, and the top layer. The higher you go, the more the rules and regulations the RBI will impose, and more rules and regulations the NBFCs will have to follow. So this is the scale based regulatory framework. Okay, this is the scale based regulatory framework. So the NBFCs support credit delivery. The non-banking financial companies, they support credit delivery along with banks, but RBI had observed that the sector had grown in size, complexity and interconnectedness. Therefore RBI felt that very large NBFCs, they could create systemic risk if they failed or faced stress. So this is why RBI introduced the scale-based regulatory framework for the NBFCs, so that the very large NBFCs, they are following more rules and regulations so that they do not become too much risky, or they do not fail, they do not come into the stress. Okay, so that's why the NBFCs were divided into the different layers, so that the large NBFCs that have too much interconnectedness, they can be they can be taken care of so that they follow more rules and regulations. So under this framework, NBFCs are placed in four layers based on their size, activity and the perceived riskiness. So as I've told you that the NBFCs are kept in the four layers, in the base layer, middle layer, upper layer and the top layer, on the basis of the size, activity and perceived riskiness. Now RBI has made some revision regarding the methodology for identification of the NBFCs in the upper layer. So before, see, it was clearly stated that which NBFCs will come in base layer, which NBFCs will come in middle layer, and there was a methodology that was given, that on the basis of the perceived riskiness, on the basis of the riskiness that is considered by the RBI, the NBFCs will come under the upper layer. Okay, so this was the idea, that before there was a clear cut methodology, there was a parametric methodology for identification of NBFCs in the upper layer, that which NBFCs will go in the upper layer, and the placement of government owned NBFCs in various layers, that NBFCs will be placed in which layers, in the base layer, middle layer, upper layer, top layer, in which layers the NBFCs will be placed. So now there is the update that has happened in the methodology for identification of NBFCs in the upper layer, as well as the government owned NBFCs that will come in which layers. So previous rules on classification of upper layer NBFCs. So upper layer is meant for NBFCs requiring enhanced regulatory requirements. Under the earlier method, RBI used a parametric scoring methodology where 70% of the weight was given to the quantitative factors such as the size and leverage, interconnectedness that the NBFC has, and the complexity of the NBFC. While 30% of the weight for the qualitative, 30% of the weight was given for the qualitative factors, the qualitative parameters, or the supervisory inputs, such as the nature of liabilities, the group structure, and the segment penetration. Okay, so previously, under the parametric methodology, the NBFCs were selected for the upper layer on the basis of the 70% of the quantitative factors, like 70% of the weight that was given to the quantitative factors and 30% of the weight that was given to the qualitative factors. So these were the quantitative factors and these are the qualitative factors. Also the top 10 eligible NBFCs. So top 10 NBFCs with the largest asset size, they were automatically placed in the upper layer. So which NBFCs used to come in the upper layer? Now I hope you know that the NBFCs that come in the upper layer are the top 10 NBFCs on the basis of their asset size, as well as the NBFCs that have been selected on the basis of the methodology that the RBI has had given on the for the risk perceivedness. Okay. Now the government owned NBFCs. So previously the government owned NBFCs, they shall be placed in the base layer or middle layer as the case may be. They will not be placed in the upper layer till further notice. This was stated that the government owned NBFCs, they can either come in the base layer or they can come in the middle layer. Now what has changed now? So RBI has moved from the complex to scoring based approach. Now RBI has removed this 70% of the weightage for the quantitative factors and 30% of the weightage to the qualitative factors and so many of the different like parameters. So RBI has now moved from a complex scoring based methodology to a clear asset size based approach. Now RBI will annually identify NBFCs for the upper layer, and the revised criteria is that NBFCs having asset size of 1 lakh crore and above as per the latest audited balance sheet will be considered for the upper layer. So this is the idea. Now the rule has been made very simple. Previously, all those NBFCs that have the assets like all those NBFCs that have the top 10, like that are in the top 10 of the asset size, they used to come in the upper layer as well as on the scoring methodology basis, on the basis of the quantitative factors and qualitative factors, the NBFCs used to come in the upper layer. Now it has been said that the earlier complex methodology has been removed, and now all those NBFCs that have the asset size of 1 lakh crore and above, they can come in the upper layer segment. Okay, so the revised criteria is very simple. NBFC is having asset size of 1 lakh crore and above as per the latest audited balance sheet will be considered for the upper layer. Now the earlier rule that kept government owned NBFCs out of the upper layer. So previously it was said that the government owned NBFCs can only come in base layer or middle layer, but now it has been clarified that now the government owned NBFCs will no longer get a blanket exclusion. They will no longer get the exclusion from the upper layer. Government owned NBFCs, they can also come in the upper layer. Government owned NBFCs, they can also come in the upper layer. Okay, so this means government owned NBFCs, they will not get the blanket exclusion. They will not get the exclusion from the upper layer classification. If they meet the revised criteria of 1 lakh crore of asset size or more than that, then they can also come in the upper layer. They can be considered for the upper layer treatment like other eligible NBFCs. Government owned NBFC will have the following, have to follow the concentration norms applicable to the layer in which it is classified. That we will discuss in the coming part. So the government owned NBFC, if it is coming in the middle layer, if it is coming in the upper layer, according to that it will have to follow the concentration norms that we will discuss. RBI has clarified that the criteria for identifying NBFCs in the upper layer will be reviewed periodically. So specifically the asset size threshold will be reviewed every 3 years. So for the upper layer, the criteria is if the asset size is 1 lakh crore or above, then these NBFCs can come in the upper layer. So this kind of threshold, this kind of criteria will be reviewed every 3 years. Okay, so this is the idea. Now this is the infographic that is given to you for your revision. So these kind of infographics are given in the document so that you can revise easily. So earlier framework was that upper layer meant NBFCs requiring enhanced regulation. They have to follow enhanced rules and regulation. So there was a parametric scoring methodology, that is quantitative factors or parameters having 70% of the weightage and qualitative factors having 30% of the weightage. And the factors were size and leverage, interconnectedness, complexity, the quantitative factors, nature of liabilities, group structure, segment penetration, quantitative factors. Top 10 eligible NBFCs on the basis of their asset size, that is the top 10 largest NBFCs, they were also kept in the upper layer. Government owned NBFCs, they could only come in the base layer or middle layer. They could not come in the upper layer. But now the revised framework is that the shift has come from the scoring methodology, which is not being followed now. Now a simple parameter is being followed. That are the NBFCs with asset size of 1 lakh crore or above to be considered for the upper layer. And the government owned NBFCs, they can come in the upper layer also. They can be in the base layer, they can be in the middle layer, they can also be in the upper layer. Now they will not get the exclusion from the upper layer. Okay, periodic review is required, that is this 1 lakh crore threshold will be reviewed every 3 years. Now base layer NBFCs shall comprise of non-deposit taking NBFCs below the asset size of 1000 crore, NBFCs undertaking the following activities. So on the basis of size, on the basis of activities, NBFC peer-to-peer lending platform, account aggregator, a non-operative financial holding company, NBFC holding the certificate of registration as type 1 NBFC, uh, that is not having customer interface, that is not taking the public funds. Okay, middle layer NBFC, all deposit taking NBFCs irrespective of asset size, non-deposit taking NBFC of asset size of 1000 crore and above, and these NBFCs with the activities. Now the upper layer, here you can see that the criteria has been modified. The upper layer shall comprise of those NBFCs which are specifically identified annually by the RBI as warranting enhanced regulatory requirement based on the criteria. That is, the upper layer shall consist of NBFCs having asset size of 1000 crore and above if they are identified by the RBI. Top layer will ideally remain empty. This layer can get populated if the RBI is of the opinion that there is a substantial increase in the systemic risk from specific NBFCs in the upper layer. Then they will be moved to the top layer. That is the layer that should remain empty ideally. But if the RBI thinks that there is too much risk in the upper layer NBFCs, then they can be moved to the top layer. So this is the idea. Once an NBFC is categorized as NBFC upper layer, it shall be subject to enhanced regulatory requirement, enhanced rules and regulations that the NBFC has to follow at least for a period of 5 years from its classification in the layer. Even in case it does not meet the prescribed criteria, still it will have to remain in the upper layer. Okay, in the enhanced rules and regulations. Now in it will be eligible to move out of the enhanced regulatory framework from the upper layer only if it does not meet the criteria for the classification for 5 consecutive years. That means once you have gone in the upper layer, once you have started following the higher rules and regulations, for 5 years you will have to follow the, for 5 consecutive years you will be in the upper layer, you will have to follow the enhanced regulatory requirement. That is the idea. Okay, chalo. Criteria for identification of NBFC upper layer shall be reviewed periodically. Further, the asset size threshold for identification, it will be reviewed every 3 years. So upper layer asset size criteria will be reviewed every 3 years. Any confusion? All clear? Now moving forward with the second article, that is regarding the concentration risk management. Okay. See, earlier the government owned NBFCs, they were placed only in the base layer or middle layer and were not considered for the upper layer. But now it has been said that the government owned NBFCs, they can come in the upper layer also. So because of the special treatment that previously the government owned NBFCs, they were only kept in the base layer or middle layer, they were not included in the upper layer. So because of this special treatment, they also enjoyed certain exemptions from the concentration norms. Now it has been clarified that the government owned NBFCs, they can also come under the upper layer, and that's why they will not get this exemption from the concentration norms. Now the government owned NBFCs have to follow the concentration risk norms. So since the government owned NBFCs can now also be considered for upper layer classification under the revised framework, RBI has made related changes in the concentration risk norm also. So this is the idea. Any confusion till now, anyone? Chalo. RBI has withdrawn the earlier exemption given to the government-owned NBFC from the concentration norms. Now, government-owned NBFC will have to follow the concentration limits applicable to the middle layer as well as upper layer. Okay, so whatever the concentration norms are there, applicable for the middle layer, that have to be followed by the government-owned NBFC in the middle layer, and the concentration norms in the upper layer have to be followed for the government-owned NBFC in the upper layer. So first, let's discuss the concentration norms for the middle layer. Okay, so for the NBFC that are in the middle layer, and NBFC except NBFC infrastructure finance company shall not have the exposure, credit or investment taken together exceeding 25% of the tier 1 capital to a single party. See, basically concentration norms means that there should not be too much loan, too much exposure to a single party. Let's say NBFC has given too much loan or has too much exposure, has too much investment in this particular entity XYZ. 50%, 50 to 60% of its loans, or 50 to 60% of its tier 1 capital, the most liquid capital that the NBFCs have, 50 to 60% of that is given in the form of exposure to the XYZ. Now, this company fails, or this company becomes insolvent, becomes bankrupt. So basically, the 50 to 60% of the tier 1 capital, that is the most liquid capital that the NBFC has, will be wiped out. So concentration, so when there is too much concentration to a single party or to a group of connected counterparties, that is two group entities, then it becomes a problem, because if that group is failing, if that company is failing, so the NBFC can come under the stress, as the NBFC has too much concentration to that particular group or to that particular individual or the company. So in this case, the it has been clarified that the NBFC, they shall not have exposure, that is credit or investment taken together exceeding 25% of its tier 1 capital to a single party. 40% of its tier 1 capital to a single group of parties. Group of parties means they belong to the same group. They belong to the same group. Let's say Reliance Industry, that consists like Reliance Power, Reliance Telecom, Geo Financial Services. So they belong to the same group. Okay. Provided that an NBFC may exceed the exposure norm specified above by 5% for any single party and 10% for group of parties if the additional exposure is going for the infrastructure loan or the infrastructure investment. Okay, so this is the idea, that 25% for the middle layer, for the NBFCs in the middle layer. Even the government owned NBFCs that are coming in the middle layer, they have to follow the concentration norms. That is the limit of their exposure that can happen to a single party, that is 25%, that can be extended by 5% in case of infrastructure investment or loan, 40% for the group of connected parties, or group for the group of parties, that is 40% for the of the tier 1 capital for the group of parties, that can be extended by 10% if the additional exposure is on the account of infrastructure loan or infrastructure investment. Okay, so single 25%, group 40%, additional 5% for the single party, 10% for the group of party. NBFC infrastructure finance company that are coming in the middle layer shall not have the exposure exceeding. So they should not have the exposure exceeding 30% tier 1 capital to a single party, 50% of the tier 1 capital to a single group of parties. So NBFC infrastructure finance company, they shall not have the exposure exceeding. Now they belong, like they are in the infrastructure category. So here you can understand that because they are in the infrastructure category, they are giving loans or they are having the investment in the infrastructure domain. So 30% for the infrastructure finance company that are in the middle layer, 50%. Okay. So the exposure are these. That is the idea. So I hope you will be able to remember this. Let me summarize it here. So NBFC middle layer, even the government owned NBFC that are in the middle layer, they should not have more than 25% of the exposure of their tier 1 capital to a single party, and 40% to a group of parties, okay, which can be extended by 5% for the single party in the case of the infrastructure loans or infrastructure investment, which can be extended by 10% for group of parties for the infrastructure loan, for the infrastructure investment. Now, uh, so for the NBFC infrastructure finance company that are in the middle layer, 30% is for the single party and 50% is for the is for the group of parties. This is the exposure limit of the tier 1 capital. Okay. Now coming to the upper layer, what are the concentration norms for the upper layer? What is the exposure limit for the upper layer NBFC? So if the NBFC is in the middle layer, even the government owned NBFC that is in the middle layer, sorry, that is in the upper layer. So NBFC in the upper layer or even the government owned NBFC that is in the upper layer, they have to follow these concentration limits. They have to follow the concentration limits. So single counterparty, if the exposure is to a single counterparty, a single company, a single borrower. So the concentration limit, exposure limit is 20%, additional 5% with board approval, additional 5% if exposure towards infrastructure loan investment is there. Okay. So this is the idea that if the loan is given to the single counterparty, so the exposure limit is 20%, additional 5% with board approval, additional 5% if exposure towards infrastructure loan or investment. NBFC infrastructure finance, group of connected counterparties. Now, single counterparty limit shall not exceed 25% in any case. Group of connected counterparties. So here, for the group of connected counterparties, 25% is the exposure limit, additional 10% if the exposure towards infrastructure loan or investment. So this is the idea that if the NBFC is in the upper layer, then for the single counterparty, the exposure limit is 20%, which can be extended 5% for the board approval, with the board approval, or additional 5% if the exposure towards infrastructure loan or investment, but the single counterparty limit shall not exceed 25% in any case. For the group of connected counterparties, 25% is the exposure limit with 10% of the extendable right if exposure is towards infrastructure loan or investment. Okay. Now, NBFC infrastructure finance company, if it is in the upper layer, if it is in the upper layer, 25% is the exposure limit, additional 5% with the board approval for the single counterparty, and 45% of the exposure limit is for the group of connected counterparties. So for the upper layer, 20%, which can be extended to 5%. Okay, 25% is the maximum for the single party. And for the group of connected parties or group of counterparties, 25%, which can be extended to 10%. Now, if infrastructure finance company is in the upper layer, so 25%, which can be extended by 5% for the single party, and for group of parties, 45% directly. So this is the idea. Okay. Now, however, if a government owned NBFC already had exposure beyond the permitted limits, let's say government owned NBFC is in the middle layer or upper layer. Before, it was not following the concentration norms because it could not come in the upper layer. So the exemption was given that the government owned NBFC do not have to follow the concentration norms. But from now onwards, as the notifications have been released, so the government owned NBFC, they can come under the upper layer and they have to follow the concentration norms. So if the government owned NBFC already had exposure beyond the permitted limits on the date of the amendment, such exposure can continue till maturity. Okay, so if beyond the limits they have given the exposure before this notification, then their exposure can continue, but the NBFC cannot take any further exposure on the same borrower or obliger. Okay. For upper layer NBFCs, now coming to the upper layer NBFCs, for upper layer NBFCs, the exposure offset by the state government guarantees. So if the state government is giving the guarantee, that means this is the exposure towards the state government. So if the state government is giving the guarantee, that means the loan or the exposure is of the state government. So for the upper layer NBFCs, the exposure offset by state government guarantee shall be recognized as an exposure to the guaranteeing state government. Such exposure shall be exempted from the prudential exposure limit, because these are not the exposure to the NBFC, these are the exposure towards the state government. So these exposures shall be exempted from the prudential exposure limit. However, since the credit risk transfer instrument, since the state government is involved, and if the XYZ company defaults, so state government has the responsibility to pay because the state government has given the guarantee against the public sector undertaking, let's say. Okay. So if the state government guarantee is involved, so here the risk that will be 20%. So this we have discussed when we were discussing the risk weight directions, that for the state government exposure, that is the guarantee, state government guarantees, the risk weight is 20%. So that is here also. Further, for an upper layer infrastructure finance companies, it has been said that the exposure, see, for the group of connected counterparties, so for the infrastructure finance company that are in the upper layer, there is 20% of the additional, there is the 20% of the additional group of connected counterparties. It is usually 25% that they have, that the NBFC in the upper layer can have the exposure. So NBFC in the upper layer can have the exposure of 25%, but for the infrastructure finance company in the upper layer, there is the 20% extra exposure that is allowed, that is up to 45% exposure is allowed. Okay, so NBFC, infrastructure finance company, if it is in the upper layer, if it is in the upper layer, so it can exceed the group exposure limit by 20%. That is, the limit for exposure to a group of connected counterparties has been amended to 45% in case of the infrastructure finance company in the upper layer. I hope this is very much clear. Okay. So for the infrastructure finance company only, there is the limit that is given, that is higher than the group of connected counterparties for the normal NBFC upper layer by 20%. So in total, 45% is the limit for the group of connected counterparties, exposure limit for the infrastructure finance company in the upper layer. Now coming to the last direction that we have to discuss, coming to the last article that we have to discuss. So Reserve Bank of India NBFC Governance Amendment Directions 2026. Any confusion till now? All clear? See, earlier the government owned NBFCs were placed only in the base layer or middle layer, but now they are considered for the upper layer also. So, since government owned NBFCs can now also be considered for the upper layer classification under the revised framework, RBI has clarified in the governance norms. There is the clarification that has been given in the governance norms. So, as per the RBI, NBFC Governance Directions 2025, and upper layer NBFC an upper layer NBFC shall be mandatorily listed within 3 years of its identification by RBI in the upper layer. So, when the NBFC is identified and it is included in the upper layer, it has to be mandatorily listed. Okay, within 3 years of its identification by RBI in the upper layer. What does the amendment say? These provisions shall not be applicable to the NBFC upper layer which are fully owned and controlled by the government. That means the government owned NBFCs in the upper layer, in the upper layer, they do not have to follow this criteria. That means it is not mandatory for them to get listed within 3 years of its identification in the upper layer. So usually NBFC upper layer shall be mandatorily listed within 3 years of its identification by RBI in the upper layer. Okay, disclosure requirements shall be put in place on the same lines. Now, provided that these provisions shall not be applicable for the NBFC upper layer, which are fully owned and controlled by the government, these directions will not be applicable. They do not have to get listed within 3 year timeline. So that is the idea. So these were the three articles that we have discussed, three notifications of the RBI that we have discussed regarding the scale-based regulatory framework. Okay. Now, I have brought the questions for you. Such kind of question can come in the phase 2 of the RBI Grade B examination. So if you are preparing for RBI Grade B 2026 examination, such kind of question can come. There can be a paragraph that can be given that the RBI has amended the regulatory framework governing NBFCs. Under the revised framework, the methodology for identifying NBFCs for upper layer has shifted from scoring based approach to asset sized based criteria. So you have to give the answer of these following four questions on the basis of the paragraph. First is, under the revised methodology introduced by the RBI in 2026, an NBFC will generally be considered for placement in the upper layer if it has the asset size of at least what? So I hope you will be easily able to answer this question. Coming to the second question, the revised asset size threshold for identifying NBFCs in the upper layer will be reviewed by the RBI at what interval? So the revised asset size threshold for identifying the NBFC in the upper layer will be reviewed by the RBI at what interval? Very easy question. Where an exposure of an upper layer NBFC is offset by the state government guarantee, the applicable risk weight shall be what? So, where an exposure of an upper layer NBFC is offset by the state government guarantee, first of all, it will not be included in the prudential limits, it will not be included in the exposure limit, and the applicable risk weight shall be what? Now, coming to the last one, following the 2026 amendment, the exposure limit of an upper layer infrastructure finance company to a group of connected counterparties has been revised to what? So, what is the total exposure limit of an upper layer infrastructure finance company to a group of connected counterparties? This has been revised to what percentage? So, these are the four questions. I hope you will be easily able to answer these questions. So, these are the homework questions that you have to answer in the comment section below, as well as if you want to get the PDF of the session, then you can get the PDF of the session in the Telegram channel of EduTap. So if you want to get the PDF of the session, it will be provided to you in the Telegram channel of EduTap, okay? As well as do give the right answer of the homework question. Whoever gives the right answer of the homework question, I will comment down below that the answer is correct, okay? So this is it for today. I hope you enjoyed the session. Now see you in the next session.